Let's talk markets for a moment because the markets will be picking through that number, a number, I should say, of economic and corporate earnings reports this week, including key inflation and retail sales. A lot of folks still trying to get over the jobs number from Friday. And then starting Friday, we're going to get earnings from some big banks. Averages will also get the first chance to react to last Friday's employment report, which showed 236,000 jobs were added in March, in line with expectations. For insights and how all this could play out in the markets, let's bring in Cameron Dawson, Chief Investment Officer of New Edge Wealth, and covering the economic angle is Kevin Cummins, Chief U.S. Economist for NatWest Markets. Good morning to both of you. Cameron, I'm going to start with you. Let's hit the jobs number on Friday, but try to roll it forward in terms of how you see some of the numbers we're going to see this week relate to it.
Yeah, I think that the jobs number does definitely increase the probability that the Fed hikes 25 basis points in May, and that you'd have to see a big, huge downside surprise to the CPI number to really change that probability or move it lower. When we look at the CPI number, what we do see is that we have to remember we need to look at the month-over-month numbers. That really gives us the best indication of the underlying inflation impulse within the economy. And then, of course, that core services ex shelter is that super core CPI that the Fed will watch very closely. That reaccelerated last month, moving in the wrong direction from the Fed and still remains very elevated at about 6.1%. So I think all eyes will be on that number when we get into Wednesday.
Kevin, you in the same camp?
Yeah, I mean, the CPI certainly has been the focus, and it's going to remain the focus ahead of the FOMC meeting. There are a few other pieces of information that the Fed will get leading up into that May meeting. I'd say one of the other things that the Fed's really concerned about is wages. So we'll see the ECI later this month. But most importantly, I think what differentiates a little bit this meeting relative to the last meeting is that they're going to have a Fed senior loan officer opinion survey. We won't have the details of that survey until after the FOMC meeting, but I do think it's something that the Fed's going to be very focused on going forward, and to see the extent and the pervasiveness of tightening and lending standards in the wake of the turmoil in markets. So that's another piece of information that officials will have ahead of that meeting that's a little bit different relative to the other meetings that they've had, where it's been pretty much expectations that they're going to continue to tighten rates. So I think that
question for Cameron and Kevin, it relates to the rates issue, but also relates to the extent we're still in a banking crisis, and we thought that might actually help with the inflation story. How concerned are you about some of the, we're going to hear earnings reports from some of these banks. We're going to hear about their deposits. We're going to see where things really stand. What do you think we're going to see?
So I think we have to listen.
Oh, I apologize. Cameron?
So I think we have to listen to two things very closely. What their expectation is for future loan growth. Loan growth is so very important for economic growth. And it's one of the reasons why economic growth remained so resilient last year, is because loans continue to run at a double-digit pace. So if banks are talking about pulling back on loan growth in order to preserve liquidity, that could spell more weakness for the future economy. Then, of course, it's on the loan loss reserves. So that gets a sense of credit conditions within the economy. If those continue to tick up, that could be a sign that banks are concerned about underlying credit conditions.
Kevin, you were jumping in there.
Yeah, I would just piggyback on that and say, that what we saw even through January, when the Fed's last senior loan officer opinion survey, there was a very pervasive tightening in lending standards that borrowing costs have increased. So even back in January, when the survey was conducted, if you look at the details of that report, it suggested that banks were expecting even further tightening in lending standards. And this was all ahead of the turmoil in the banking sector more recently. So I think, it's pretty safe to assume that we're probably going to see even more tightening in lending standards. And, the jobs data certainly have been very resilient. We've seen a somewhat of a slowdown throughout the quarter, but I think it's a matter of time, and it seems inevitable that the economy is going to show more restraint because of tighter credit on labor and capital and GDP, so that the economy is probably going to start to show more evidence of slowing than what we've seen so far. So I think that's on the minds of Fed officials in May.
So the conventional wisdom, I don't say it's conventional, but I would say everybody seems to think we are moving into a more contractionary period, maybe recessionary period. Is there any upside surprise here for either of you?
I would say from the economic standpoint, the fact that we're still adding over 200,000 jobs is very impressive. We've saw a step down in the pace of job growth. If you look at January, it's 472, 326 in February, and then 236 in March. So, income growth should continue to move forward, and that obviously has helped consumption. For the first quarter, consumption looks like it's probably going to be somewhere in the neighborhood of 4%. So, the economy hasn't rolled over just yet, and it's an expectation that has been a long time coming. I mean, we've been talking about a recession for so long now. It's the most widely anticipated recession probably ever. But, shocks are what ultimately pulls down the economy. And this has been probably a pretty big shock that's only a matter of time. That seems like things are going to be more weaker than expected in the coming few months.
Final word to Cameron, an upside surprise or nothing?
Well, I think that the equity market is already expecting a reacceleration in growth. If you look at fourth quarter earnings for 2023, they're expected to reaccelerate to 8% growth compared to negative 8% this quarter, and then rolling forward to 2024, another 9% growth. So there is some optimism already baked into numbers that the worst after this quarter could likely be behind us and we start to recover from here. I think that remains to be seen, mostly if we do see a fall off in that credit activity.
Okay, we're going to leave it there. Thank you both. Appreciate it.